I'm Michael Boxer. This is the Prospector podcast, and I have joining me returning guest Mike McGlone, senior commodities analyst for Bloomberg Intelligence. Welcome back, Mike.
Thanks, Mike. It's good to be back.
Yeah, normally we would do this about a month later in sunny Florida, but the Mines and Money event isn't happening this year. We have to look at each other through the computer screen and not in person, but that's the way life goes sometimes.
Yeah, well, we'll see you next time.
Yeah, no, absolutely. So I wanted to do what we normally do at this time of the year. I want to do a review of what we discussed and what we thought was going to happen to 25, see what we got right, see what we got wrong, and what surprises occurred that we didn't see at all. And then we're going to take a look forward into 2026, and it's been a tumultuous couple of weeks already. So I'm sure there's going to be lots of things that we could discuss about 2026. But let's go to our Wayback Machine to last February when we last did a year review. You were pretty bullish on a lot of the commodities, but not so much copper. But copper seemed to have held up. So. How were your predictions from 2025? Were you spot on, or were there any surprises?
I think it's best to start where I was wrong. Number one, macro. I didn't think the stock market would continue to rally at that pace it has. I did not think copper would go up that much. It did have a good reason for that, and it had a great trading year. But the bottom line for me, the number one things that surprised me was the velocity of the rally in gold, and particular silver and all the other metals. Gold led the way. Beta, it made sense. Gold should have continued, it did continue going, but in a volatility with stock market going up, volatility should continue. Gold should continue outperforming. But what happened is stock market volatility collapsed, and then the other metals took off, particularly silver. So as we speak now, silver's high for the year now, we're speaking on January 16th, is 93. And to me, what's happening in these massive rallies in metals is you cannot underestimate how it's going to shift the supply-demand deficit balances. Parabolic prices will do that. So that's the key thing. The gold-silver ratio's high last year was 107. I did not think it would get to below 80. And it did collapse. And as we speak right now, it's gold silver is about 67, and it's plunged to almost 50. I'm sorry, no, that's gold. Gold silver is 51. It plunged just below 50. It plunged to 49. And to put that in context, that move of 54% was the greatest in our database in the shortest period of time ever. Now, I can go back maybe 100 years on that. And the key level now, it's just at a great support level. So I just look at what's happened last year is, yeah, I didn't underestimate, way bullish all metals. But now that we've reached these extreme levels, you have to be very curious, very risky about the up too much risks, which afflicted cryptos last year. And that was one of my favorite calls that actually went right.
Yeah. If I were to look back on myself personally, the silver market is what surprised me the most. I expected it to bump up against that $50 ceiling several times, just as gold had done at the $2,000 ceiling a few years ago. Before finally breaking through, and it broke through in one charge and just took off. Like you say, we're well above that $50 mark now. I kind of expected silver, once it broke through, to run like this, but not at this pace either. If you were to look back, what's been the driver that pushed it through that rapidly and kept it going?
Well, right now, I think we're in a silly speculative stages. Everybody points out that the fundamentals have been in place for 1, 2, 3, 4 years at least, and that's obviously slower demand. There's potential for U.S. tariffs. There's the potential for the critical minerals list to be part of that for the U.S. So it's a lot related to Mr. Trump. That's one thing I do like to point out, is one thing we did learn last year is the gold market absolutely loves Mr. Trump. We can put all the precious metals in that space, but gold is the only precious metal now. Silver's not precious anymore. It's almost 60% demand is from industrial sources, and most notably solar. And to me, right now, we're just speculative frenzy stages. I don't care why it went up anymore. I only care about what it means and matters. I switch over to my risk manager hat as a disciplined strategist and professional and someone trying to predict markets. And what's happening in silver this year, if history's a guide, it potentially can put in a high for decades. Now, where that high is going to be, I don't know. The only time in history we've rallied this much versus, say, a 60-month moving average, or about 3 times, we can go back to many different moving averages, was that peak in 1979 and 80. In 1979, when the Hunt brothers tried to corner the market. And just to put in context what can happen, and I suspect will happen after 2026 in silver, is that close in 1979 in silver was $32 an ounce. And last year's low was 28. It's called the devil's metal for a reason. It's going to inflict pain on both sides. And I fully expect it's going to put an enduring high this year. I don't know from where. It could get to 100 and then back to 50 and mean nothing. We should get 10% days in this market now. It was up almost 30% on the year. As we speak, it's about 25%. And that's only 2 weeks into the year, Michael. So the key thing to remember is parabolic rallies will always offset supply-demand imbalances, particularly when they come in the first week of the year. You have to be very careful. So a good example I like to point out is crude oil put in a high last year around 80, WTI right around the first month of the year. Corn did the same thing around 5 first month of the year. And as a commodity person and trader, you look at this and say, yeah, shorting the market's difficult, but if you've been long it forever, like a lot of people have, prudent profit taking is what the market's telling you right now.
Okay. Now, we talked about copper last year, and copper was trading well above what was expected, and it continued that way through the whole year. That was probably one of the surprises on your bingo card as you were projecting copper to maybe slide back more to its $4 level than rather than the 6 that it's sitting at. Copper seemed to should have had headwinds, but they never really held it back.
Yeah, so I will go out on a limb and I think copper is a worthy short this year. Obviously, I tried that last year, consider getting stopped out, but it gave you some great trading environments. Remember when I started at 4, went to 530, back down to 4, then up to new high, and then back down to 4.5. It just gave you some great trading. So I view copper's move this year to a new high above 13,000 a ton and just above $6 a pound is a worthy short, meaning right now it's as we speak 580, so it's dropped below that. It's dropped almost on just today 3%. It's a worthy short, I think, because if copper stays above 6, it's a new high. It's indicative of the whole global demand pull economy doing fine, China doing okay, and us coming out of this malaise, and U.S. stock market staying strong. It's the number one thing to remember. The Bloomberg Commodity Industrial Metals Index was up about 20% last year. That's exactly the same as the Bloomberg Global Market Capitalization Index for stocks. It's the same trade right now. So anybody who's bullish copper, number one, you probably have to have the stock market going up for it to stay that way. Yes, we all get the supply deficits that kicked in last year. We all get the tariffs and all that kind of stuff. But when prices move like this, it'll adjust those factors. So I view it as a worthy short. I think the initial, maybe I'm not making trade recommendations, but hypothetically, it can easily get back down to 5 and mean nothing. But the bottom line is similar to like Bitcoin. Bitcoin popped above almost near 100,000, between 94,000 and 100,000. I view it as a worthy short because these are risk assets. One of them is still in the bull market. That's copper. I think it's potentially rolling over. And one of them is in a bear market. If it's 200-day moving average. And the way I see this year, Michael, is volatility in the stock market so low. It's really only one way for it to go. It might stay low for lucky, but my base case this year is volatility is going to pick up in the stock market, which means we might have a down year. And it's probably going to be a great year for those who are much more responsive, tactically orientated in trading, meaning coming in outright long. Some of these assets have been up a lot, might be somewhat risky. So I look at it this year so far. What's your first opportunity? All right, copper popped. It might be a worthy short. Bitcoin popped. It might be a worthy short. Now you start out nimbly. Now that's more of a trader's environment. But for a macro environment, I'm just looking at coppers. Please prove me wrong. I don't mean prove me wrong, but proof strength. Stay above 6. Don't do what's normal. Go back to 5, which is much it always does. And a key thing is to do that, like I said, is just a little pickup in 180-day volatility now. On the S&P 500 is 11%. I started saying that when 60-day volatility was 11%. So you see what the factor is here. The U.S. stock market has to keep going up, which is completely priced in. We fully expect we're going to get another 10% year. And I think the risks are it might be a down 10% year. And I'll end with this. The main reason I'm emboldened to say that is what happened in precious metals last year. We have never had a year with gold rallying at such velocity, particularly crude oil going down, with stock market volatility staying so low. That's just never happened. So I don't think it's going to be different this time.
Okay, we always talked about Dr. Copper being a PhD in economics, and that is it decoupled from doing that? And is oil the better? Should it be Dr. Oil? Should we be looking at the oil and the crude markets to be a more of an indicator of the economy than copper?
Well, I'm glad you went there because that's a key dichotomy of last year. I mean, the most significant industrial commodity on the planet is crude oil. Then maybe one or two net right after that is copper. Copper is also much more of a better indicator historically. I mean, you can overlay the price of copper in terms of pounds on U.S. Treasury yield, and it's about the same historically over time. I think the key thing to think about here is that's why I'm still somewhat very skeptical about copper. It's much more, yes, it's less elastic. It's in the metals. I love the metals. If you're a commodity guy, metals are the only ones that really go up over time, but they can get too expensive. The bottom line I see here is, yes, we had those unexpected supply issues, and then we had the tariffs kick in. And what's that going to do? It gets everybody bullish at the wrong levels. We saw what happened with crude oil at 130 in 2022 when people got bullish at above 100. We saw that in corn recently. We've seen it in a lot of other commodities. So I view it as it's one of those the leading indicators, like I said, is proof it's not just a little bit of a in the year by staying above 6. And just as we speak, it's already dropping. So I look at it as it's at high risk of similar to silver and platinum and even gold. All the metals are just so expensive. The lessons are people who've been bullish these things forever, the miners and the equities, is to not be doubling down on a 2 or 3x in the last few years. It's just catching up to way underperforming, but now it's getting too expensive. And I'm just worried. I think they're all in the same bucket. It's just copper's more the adult compared to silver. But they're similar. If I have a short signal potentially in copper on 6, that pretty much means, yeah, maybe silver gets to 100, but it's more likely to go to 50.
Okay. Now, am I right or am I wrong with this statement? I look at the commodities of 2025 and they were all moving upwards. Some of them were out above their skis and others. And then I looked at the dollar index, which was remaining rather stable against the other fiat currencies. And the thesis that I'm starting to think about is, are the commodities actually showing a weakness of the US dollar rather than the US dollar index?
That is, I'm not. It depends on. Let's put it this way. I don't really know. I'll just give you my outlook. First thing, what happened last year in commodities basically has never happened. We've never seen the broad market. Bloomberg Commodity Index was up about 15%. S&P 500 was up about 17%. Bloomberg Dow Index was down about 7%. Now, in that environment, commodities are supposed to go up when the Dow is doing well. The stock market is supposed to go up. I'm sorry, when the Dow is going down. They're Dow-denominated assets. The key thing remember about commodities, what's never happened is what happened last year, where only one sector went up, metals. Energy and agriculture went down, the major sectors. And they're still going down. The bottom line is they face the up too much risks of going. They're still in low price cure cycles after going up too much to the peaks in 2022. What did that do? It completely incentivized pre-existing trends of being able to create more with less, shifting over the EVs, producing more corn, soybeans, and most notably corn and soybeans from South America. Price went up, and North America, and bringing out all that excess supply from U.S., Canada, Guyana, Brazil, Argentina, and of course Venezuela going in the future, taking the mantra of price maker into the Western Hemisphere, and shifted over to the things like technology reducing some of the demand, i.e. EVs. So I think that high price cure will probably be alleviated this year with low price cures, which means we have to probably get cheaper. But they are bear markets. The difference is the metals is the only bull market, and that's getting really inexpensive. So my bias case for next year in commodities is the Bloomberg Commodity Index is completely dependent, the broad market, on the stock market. If the stock market goes up 10% as expected, commodities will probably be fine. The broad index will go up 10%. But if stock market drops 10%, I expect entire space, most notably copper and silver and all the industrial metals and crude oil to drop 20%. And even gold might suffer because it's just so expensive now versus most moving averages. The history of when a parabolic moves in gold is if you weren't in it before, buying it after it goes up and buying almost all commodities after they go up is very risky. The key thing to remember is gold is the least elastic of all commodities, and the most elastic are the grains, and they're the ones still under pressure.
Okay. Last but not least on the 2025 discussion, and it's a good segue to get us into 2026. You stated that the stock market volatility is really not been there in spite of the volatility politically all around everything. And you said that, volatility returning could cause volatility in the commodities, et cetera. Why has the stock market been calm in spite of the volatility around it?
Well, that is one thing I enjoyed seeing Ed Yardini at the Greenwich Economic Forum in October and having a conversation with about him. He says it's not much you can do. It stops when it stops, and right now it's going up, and that's all that matters. It's, to me, in the late stages of a bull market, and people have heard that from me before, admittedly so. But I found much better ways to find alpha. First in Bitcoin, I jumped off that horse in 2024, and certainly in gold forever. And I'm jumping off that horse now. I think the gold alpha stage is over. And it's a bottom line to me is not so much why it's been going there. Obviously, it's the U.S. exceptionalism. The system's great. You can't get much better than the way things are in this country. I mean, inflation is somewhat declining. Unemployment is low, picking up a little bit, and GDP is running fine. Amen. I mean, so far so good, but can it get much better? It's just the point of when prices get too expensive, that can be all that matters. So we've reached 2.4 times GDP and U.S. stock market capitalization. Now, people say that might not matter. I say, well, okay, well, it's about a 25-year high, the S&P 500 versus the Bloomberg Commodity Index. And we did reach, just in 2025 at the beginning, the highest ever versus the rest of the world in U.S. stock market. So that's starting to roll over. So how long we can stay here is debatable. I just look for alternatives. That's why I found gold. And that's what, to me, what's telling us the risk is we're just due for some normal correlation. I think we're at the stage now is when you see things from, we reached an end game, i.e. it's basically an anathema for Mr. Trump to think of anything other than, being a cheerleader for the stock market. But we're at the stage now, it is the economy. When you get 2.4 times GDP, there's only two times in history, the US in 1929, we got near there, and Japan in 1989, that it becomes the economy. And if the stock market keeps going up, it means inflation. And the number one issue in all elections now is affordability and inflation. So I think that's part of the reach the end game of the lose-lose of being able to pump risk assets with fiscal and monetary stimulus. And to me, that's what gold's figuring out. Even Bitcoin, highly volatile crypto asset that was supposed to go up last year and went down, is telling us I think there's a problem with risk assets. And that's why this year is so important. So that's why I look at it initially is, okay, copper's got to stay above 6, and it looks like it's breaking down from there. Bitcoin has to stay above 100,000. It tried to get there, and it's not working. It looks like it's breaking down. By the time we have this conversation at the end of the year, I think we're going to say, well, those are the warnings. Did you heed the warnings? Gold going up at the greatest, taking alpha at the greatest pace since 1979 might be the warning. That's the way I'm looking at markets this year. So I see in commodity, I don't, surprises I can't predict. I can't see what's going to take for energy prices to go higher, except a low price cure if they get much lower. Some kind of supply shock, which I can't predict. I can't see what's take for the grains to go higher, except from some kind of supply shock I can't predict. If anything, they'll probably get to those low price cures. And I can definitely see what's going to make the metals go lower. And that's one simple fact. They went up too much. That's what happens with commodities. They're not like stocks, so they can, you can have earnings and higher prices bring on more FOMO. What typically happens in commodities, it brings on greater supply and less demand.
So are you projecting a bear market for commodities in 26 or just simply a correction?
I'm predicting a bull market for volatility. I'm expecting a bear market for the stock market, and I think that's going to trickle down to everything. I think it's going to be a deflationary year. I mean, we're way overdue for deflation like they've had in China for the last few years. I mean, that 10-year note yield, people have heard me mention it before, is at 1.84% in China for a reason. That's severe deflation. And there's only one thing on the 1 to 10 scale on the planet, the most ever, to give us inflation or deflation this year, Michael, is the U.S. stock market. It absolutely has to go up. Now, the bottom line is, people have heard me, say this before, somewhat bearish in the stock market. But before, like I said, it was great alpha in Bitcoin. Well, that's over. It got overdone. Trade's done, I think. There's great alpha in gold. Well, that I think is over now because it's just gone up too much. So to me, the next key thing we're going to be talking about at this time next year is this U.S. stock market was way overdue for a correction, and it got it. So that's why I'm playing it right now. But in the meantime, if it feels like it's never going to happen. That's when it does. But all these other peripheral markets are just so scary. I look at this Bitcoin to gold ratio. Basically, it takes 21 ounces of Bitcoin per one of gold per one Bitcoin. That's broken down hard. Last year's high was around 35. That's been a great leading indicator. We have a model that says it should be closer to 15. You know what that means? If that leading risk asset's going down, cryptocurrencies have rolled over. Their 200-day moving average has declined. That's the Bloomberg Galaxy Crypto Index. To me, all the signs are there. This is just getting started, Michael. We need something to prove me wrong. Starts with copper staying above 6, Bitcoin staying above 100,000, and the stock market at some point, I think, is going to heed the warning. But that's the bottom line. Is we're talking about. I think it's the number one source of inflation or deflation or recession or expansion, and it's the stock market. It has to keep going up to keep the expansion going.
Okay. Now, is there a particular trigger for this stock market correction that we're overdue with? God knows there's been lots of volatility and lots of abnormalities in world politics these days that you would think would break a stock market downward, but so far it's held up.
Well, here's a scenario that's really opposite consensus for Mr. Trump to get reelected in midterms. Right now, the consensus is going to run it hot. Everybody gets it. Everybody knows. Everybody expects it. Yet that's a bad thing, because the number one thing for elections now is inflation. You run it hot. I mean, what part of running it hot does not mean inflation? It's all about inflation, particularly pushing back on the Fed. That's inflation. Tariffs are inflation. The key thing he's getting right is, energy is going lower. So I think the key thing for this year to think about is one simple little thing might actually help Mr. Trump get elected. Let's say a 10% correction in the stock market that stays down for a while. You know what that would do, Mike? It would take energy prices, crude oil that's hovering around 60, take them right to a 40 handle, I think. U.S. average gasoline price around $2.80 a gallon, bring it right down towards 2. Natural gas for March and April are running like 2.6. The high was 5 last year, not in those contracts, but in the front contract. Get those towards 2. And those levels are completely not profound. That's where they typically bottom. So energy prices would go lower, check mark, and be great. Interest rates, right now, that 10-year yield about 4.2, probably easily drop to a 3 handle, easy, if we went down 10% and stayed down. Another check mark. If Mr. Trump said, yeah, I got rates down. I got inflation down. I got energy prices down. And the stock market, those rich people, who didn't vote for me, that's their problem. So that's one scenario I'm looking at. I don't know how it's going to play out, but all I look at is the triggers. I don't know, Michael, but the markets are telling me this is what you should expect. And just waiting for the signals. And like I said, so far, we've already had a few opportunities I thought were worthwhile. Being a responsive seller of crude oil, of copper and Bitcoin earlier in the year. And remember what time of year it is. We're only January 16th. We're only 2 weeks into the year. This is where silly stuff can happen. You have to be responsive. I'll give you one example. Corn put in a high right in January last year around 5 and then dropped down to 3 and change. Crude oil put in a high around 80 in January and then dropped down to 55. This is the time of year you're supposed to probably be countering some of the first moves.
So if I were to sum up this conversation is buckle up, folks, put on a safety helmet. It's going to be a rough ride.
It's going to be a rough ride for people who are overweight, long risk assets that went up a real lot. Unfortunately, now that includes the metals. Those of us who've been holding metals for decades and finally they broke out, probably time to consider lightening up. And I think that's what's happening a little. Mark Mobius said that today. But for the tactically oriented responsive traders type, which used to be my mantra working as a hedge fund and in trading pits, this is going to be an ideal year, I think, Michael. Sit back, wait for the opportunities and pounce. But coming in offsides and getting caught offsides can hurt. And I think the bottom line this year, I think what's after gold grabbed alpha last year, I think it's only logical to look back from the future and say, yeah, it made sense that U.S. Treasury bonds grabbed alpha this year. That's what I think might happen.
Okay, there's the final word, folks. If people want to follow your work, Mike, how would they do so?
On your program, thank you for having me. I enjoy playing show and tell, a little bit less show, but I love the tell. I'm on X at Mike McGlone 11 and at LinkedIn, Senior Commodity Strategist, Mike McGlone at Bloomberg Intelligence Senior Commodity Strategist. And people want to reach out, and I'm happy to add them to my distribution list. And again, Michael, thank you for having me on.
Not a problem, Mike. And given the state and nature of how this could be a bumpy year, you might be on a little bit more this year than last.
I hope so.
Me too. Thank you. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.